So once you get the correlation coefficient, then you run the covariance matrix. Okay. Once you get the covariance matrix, you jumped a major hurdle in doing this optimization. This is basically chapter 8, right? Chapter 7, chapter 8, the optimization. But I expanded it from the book's illustration to an application here. So once we get the covariance matrix set up, so you got to do the 2 correlations, and then you got to do the covariance. Once you do, you guys got to follow along because this stuff is hard. And I'm going to come around and check on you guys and see how you're doing on this stuff. So there's a lot of procedures to this thing. But once you get it down, you're in, okay, and it'll get easier. So once I get the covariance matrix, I go back to the stock portfolio optimization page. Go up to the top here. And if you did some research on your stocks, maybe you did some research, got some outside research, that gave you some return expectations for 2018, and you calculate the percentage change, and you can get a projected expected return for 2018. For some of these, I just looked at the mean and the median, and for Apple, they did an annualized return of 22% per year of the last 5 years. So you have to ask the question, do you think Apple continue to do it? Well, I don't know. I was watching Apple do the demonstration on their new iPhone X this morning, and it seems like it has some product features that will create a reboot and refresh, and people will buy the phone, so that's just going to generate more revenue. In earnings, so I probably expect that that they'll probably do another 22% in 2018, so I just hard-coded it in there. IBM, I read about today from Seeking Alpha, they're imploding, but I gave them at least 3% just to be nice to them. Microsoft, they've done about 22% per year over the last 5 years. I don't know if they can continue to do it, so I just toned down my expectations to 15%. Oracle's done around 8% to 9% per year over the last 5 years. I said they could probably do that again this year, so I gave it an 8%. And you just go through these and you plug in the return series, and then I'll walk you through the optimization procedures. But you got to get the data in there. You got to check and see if they have returns for the 5 years. If they don't have it for the 5 years, you're going to run the correlation matrix, and then you use the correlation between the 2 stocks to fill in the returns for the ones that don't have it, rerun the correlation, run the covariance, and then do the expected return forecasts. And now you're ready to set up to do the optimization iterations to trace out the efficient frontier. And then do the last optimization to trace out the capital allocation line. And then you're going to identify the iteration that's going to be tangent. You're going to pick, your efficient frontier is going to look like that. Well, these are infeasible portfolios. Why would I construct a portfolio that has low return and a high risk unless I go short? I'm not. So I'm probably going to just choose that. And the one that's tangent right here is the one that has the highest Sharpe ratio. Although I didn't use Sharpe ratios, theoretically I should have used Sharpe ratios, but I just used the expected returns because that's what I'm selling to the investors is the benchmark returns. And really taking out the risk-free rate, in my view, is just a constant, so might as well just take it out anyway. I mean, Sharpe is correct, but I think from a practical standpoint, I'd rather see expected returns on the portfolio here than basically the risk premiums. The difference between the return on the portfolio minus the risk-free rate. And again, it's just a constant, so I threw it out. So this is the one that gives you the highest Sharpe ratio, or the highest return to risk ratio, is the one that's tangent to the capital allocation line. That's going to be the one that you sell to your investor, okay, the risk-averse investor. What you'll find out is that in my case, the portfolio way out on the tail here, this one right there, was 100% Apple stock, because it was the only stock within the portfolio that basically did the highest rate of return. So if you're high risk, high return, then you just put 100% of your portfolio in Apple. I can probably recommend that to a risk neutral investor, but I'm not going to recommend it to a risk averse investor. Okay? And And the thing that I didn't do, and I'm still trying to figure it out, I was going through chapter 7 and 8, is I would like to do the calculations for that efficient frontier graph and be able to run the three utility curve scenarios, and then try to back in and add that equation and figure out the portfolio. Well, obviously, theoretically, the utility, I want to back into the utility calculation so that it's tangent to the capital allocation line in the efficient frontier. So that's the one I'm probably going to do next. Okay, and if somebody wants to work with me on that, that would be cool. Okay, so I need to go through this with you over and over again. Okay, but I would start going up to NASDAQ, build your portfolio, get the data, get it into the portfolio worksheet, figure out which ones do and don't have the returns, run the correlations, fill in the returns for the ones that don't, run the correlation again, run the covariance, and do the projections. And if you can do all that, you don't have to do that until really after the quiz period, but I want you to start thinking about it now because I really can't wait, right? Because it's already, the procedures and the iterations is complex enough. So we need to go over this over and over again. Okay? Did you have a question?
I do. So why would you have an 8% forecast return for Oracle?
Because they basically did 8 to 9% average annual returns over the last 5 years.
Even though there's like a 71.8% correlation between Apple.
Well, I actually used Apple as the index.
Okay.
So I could have used, I could have taken out one stock and then used a tech index, right, to run the correlation. But what I found is that Apple was so dominant that almost all the stocks were correlated to Apple. So I used Apple as basically as like the market index, you know, to run the correlation, because it is the dominant one within the sector, right? So if Apple moves, it permeates over the other ones. So maybe that was a flaw in my methodology, but it seemed to make sense in this case, because I was really focusing on tech. And since Apple is so big and Amazon's so big as market cap within the NASDAQ index and in the tech indexes, I basically said Apple is systematic, right? Yeah. Apple is systematic. If Apple moves, it's going to move the whole sector. So I use that correlation off Apple as opposed to a tech index.
So if our portfolio is more diverse, like it's more in tech and medical, what should we use as an index?
You could use the S&P 500 and do almost like a beta calculation. You know, where the coefficient is like a beta.
Okay.
You know what I'm saying? A market index.
Yeah.
You could do that.
Okay.
Or if you want to run the correlations within your sectors.
So have multiple of those then?
So you break up your portfolio into different sectors.
Yeah.
Maybe you have one dominant. Company within your sector, and you run the correlations amongst those companies.
Okay.
And then find the one that has the 5 years and one that only has 3, and then use the one with the 5 years correlation between each other to fill in the returns. So you could do that too. Yeah.
Since like you adjusted your forecast returns based on like research and stuff.
You could do fundamental research. Yeah. You could do market research. I know a lot of these companies, so I just gut feel.
Yeah.
And plus I use the mean and the medians as kind of a guide as an expected return.
Okay.
I know I probably should have gone negative with IBM, but I gave it inflation, basically. I wanted to have positives amongst all of these. Okay. And Oracle's pretty big and mature, so I don't think it can probably do it again.
Yeah.
Netflix probably could do it, right? eBay, probably not. It's mature, you know, so I kind of look at the companies where they are in their sector spaces and how big they are, because obviously their growth rates and their cash flows, which will, if you're using Gordon growth, is the #1 factor that's going to drive valuation. Mm-hmm. If they're at a mature phase, then the G is going to be growing at a fairly slow rate, and G is almost directly related to the stock price.
So can we do that too?
Yeah, if you want to. Yeah, you could use the fundamental securities analysis. Go right to that, put in your expected cash flow growth rates. The discount rates are pretty, standard, the multiples are pretty standard. And then what you do is once you run the intrinsic values for all your stocks, then you sort them from premium to discount, and then you can use those premium numbers as guides for these also.
Okay.
Does that make sense?
Yeah.
Okay.
I saw that Apple is the most short stock in America right now. Would that affect
Apple?
Yeah.
Yeah, it's gonna put downward pressure on the stock price. So I probably would revise this down, not from 22, but maybe take it down to 12. And I would look at the run rate on Apple right now, year over year as of today. And then basically you divide it by 3 and multiply it by 4, you get an annualized run rate. Does that make sense? So if I have basically 3 quarters, or 9 months, so I basically take the percentage change between the stock price as of January to today, it's 9 months. So I take that return divided by 9, multiplied by 12. Right, so I'm taking the returns and making it into a monthly. And then I'm multiplying it by 12 to make it an annual. So I could do that too as another way to guide me on these returns. Okay? But once you set the returns, you cannot change them. Okay? Because that's what I did. I set the returns, I ran through the optimization procedures, traced out the capital allocation line of Fishing Frontier. It was freaking beautiful. And then I went back and I said, oh, I'm gonna start messing with the returns again. And then I reran it again and it messed up the whole Fishing Frontier and everything. So you might have to do some iteration on the optimization procedures. But if you add in the returns and run through the optimizations and it works and it looks good, walk away. Okay? Walk away. Sometimes your worst enemy is yourself, right? When you second guess yourself. Okay, so let's do the problem. So let's start over there. And then how much time do we have? What? 30. Okay, so let's go. Was anybody not here on Friday or last week? Okay, perfect. Okay, go ahead.
So I'm chapter 2, number 12. It uses the data from number 11, so there's a chart on there. And using the data from that column, calculate the first period rates of return on the following indexes of the 3 stocks. So A is the market value weighted index, and so use T equals 0. And then stock price is 90 times 100 shares, and then 200 times 50 shares, 200 times 100 shares equals 39,000. And then at T equals 1, got 100 shares at 95, 200 shares at 45, and 200 shares at 110. And so you just use the 40,500 over the 39,000 equals 3.85%. And then B for the equally weighted index, use return period A. 95 over 90 minus 1 equals 0.0556. And then B, 45 over 50 minus 1 equals negative 0.10. And then period C, 110 over 100 minus 1 is 0.10. And then those 3 periods divided by 3 equals 1.85%.
Thank you, Jacob. We got a guy from BlackRock coming today to the Finance Club meeting. We got a guy from BlackRock coming today. If you guys are interested in going to work at BlackRock.
I did number 18, chapter 6. The question is, suppose your client prefers to invest in your fund a proportion Y that maximizes the expected return on the complete portfolio subject to the constraint that the complete portfolio's standard deviation will not exceed 18%. So A was, what is the investment proportion Y? So the investment proportion Y would be equal to Y times 28%. Since our client prefers a standard deviation of 18%, then we would do Y equals 18 divided by 28, which is 64.29% for investing in the risky portfolio. And then B was what is the expected rate of return on the complete portfolio. So we would do 8% plus the risky portfolio, so 64.29%.
Great, thank you.
So I also had chapter 2, number 17. It deals with futures contracts, and there's a chart, 2.8. So there's 5,000 bushels in one futures contract. The March 27 price was 3.96, and then it closed at 4.06. So 4.06 minus 3.96. The 5,000 contract times the profit from the closing price is a total profit of $500. I also had chapter 6, number 19. And let's see, manage a risky portfolio with an expected rate of return of 18% and a standard deviation of 28%, and the T-bills are at 8%. The client's degree of risk aversion is 3.5. So what proportion of the total investment should be in your fund? So solving for Y, it's the expected rate of return of 18% minus the T-bills, and then the risk aversion times the standard deviation squared is 0.10 over 0.2744 is 0.344, so it is 36.44%. And then what is the expected value and standard deviation for the client's portfolio? You use the T-bills and then minus the 10 that we solved for here, and then the Y that we just solved for up there as well. So 0.8, and then plus the 0.3644 times 0.1 is 0.1644 or 11.64%. And then the standard deviation, use that same 0.3644 that we solved for up there times the standard deviation is 10.203%.
Thanks, Jacob.
So I'm doing chapter 7, question number 22. We're starting with the bottom one. So we need to compute the estimated annual risk premium, standard deviation, and Sharpe ratio for the two portfolios. These two portfolios is for an elderly woman named Greta. So risk P for the S&P portfolio is 1 plus 0.05 to the power of 1 minus 1, which is 0.05. The 3-year premium for hedge fund portfolio is 0.1. So the S&P 3-year standard deviation is 0.20, and the hedge fund 3-year standard deviation is 0.35. So the Sharpe ratio is 5 divided by 20, which is 25, and the hedge fund Sharpe ratio is 10 divided by 35, which is 0.2857. Also did 23, same question, the two portfolios for Greta. So assuming the correlation between the annual returns in the two portfolios is indeed 0, what would the optimal asset allocation be? So annual returns is equal to 0. So the optimal asset allocation for the S&P is 0.6049, and the hedge is 0.3951. So the estimated returns would be 6.9753%, and the standard deviation of the portfolio would be 18.3731%. So you get the expected returns, 6.9753 divided by the standard deviation, and it's 18.3731, which gives you 0.3796. Thank you.
at chapter 3, questions 12A and 12B. And as suppose that you will sell short 1,000 shares of XL, currently selling for $20 per share, and give your broker $15,000 to establish your margin account. So the first problem asks, if you earn no interest on the funds in your margin account, what will be your rate of return after 1 year? If Excel stock is selling at 22, 20, and 18, and I assume they don't pay any dividends. So the way you find that is shares sold times the change in price divided by the investment funds. So you sold 1,000 shares times 2. It's also negative by the way, because you sold short. Times 2, because that's 22, so the change in price is $2 divided by 15,000. Loss of 13%. For the second part, it's 1,000 shares times there's a 0 change in price, so 0 divided by 15, 0%. Now there's a change in negative $2, so negative 2,000 divided by 15,000 equals 13% rate of return. And the B part asks, if the maintenance margin is 25%, how high can Excel price rise before you get a margin call? So the way you find the margin call point is the total assets minus the shares times the price divided by the shares times the price. So you plug in all the numbers that they gave, which was $35,000 for the total assets, which would be the amount of shares sold. So the 20,000 times 15 or plus 15 with the money you put down. So that equals 35,000 minus the stocks you sold 1,000 times the price, and then so the way you find that, solve backwards algebra. Price of the margin call will be at $28.
All right, here we have chapter 3 on how securities are traded, and this is question number 16. Here we have the proceeds from the short sale, which is $2,050, and we get that from the selling price of stock, which is $21 per share, times 100 shares minus net commission, which is $50. So that's how we get that number. And then there's a dividend payment of $200, which was withdrawn from the account. And then we have a coverage of the short sale at $15 per share with commission. We get that from repurchase price of stock, which is $15 times 100 shares, which is $1,500 plus commission $50, and you get a total of $1,550. And then to calculate the net profit of the value of your account, you're going to take the proceeds, which is $2,050, minus the dividend payment, $200, minus the coverage of the short sale, which is $1,550, and you're going to get a total of $300. And then you can also, there's a note that says that your profit, which is $300, equals the 100 shares times the profit per share of $3. And you get that $3 from the selling price of stock, which is $21, the repurchase price of stock, which is $15, and then the dividend per share, which is $2, and then the commission per share times the 2 trades, which is $1. You get, and you subtract that all, you get 3.
Okay, so you're trying to buy the stock, which is currently trading at $40, and you have $20,000 of your own capital, and you borrow $20,000 on margin with 50% margin at a 35% maintenance margin. If the stock price changes to $35, will you get a margin call? And the answer is no. If the stock price goes to $35,000, you lose $5,000 on your equity. So you have $15,000 still in the stock divided by $35,000, which is 42.9%. And that number is above your maintenance margin, so you won't get a margin call. Then the next question is, at what share price will you get a margin call? And the formula to get that is the share times the price by minus the assets, just flipped from the last question, divided by the shares times the price. And if you solve for P, the price value, you'll get a margin call. Like if the share if the stock shares fall below any price below $30.07.
Okay, so this question asks about a lady named Greta. She has a brisket version of 3, meaning she wants to diversify into 3 different sectors with a portfolio. So she wants an 18% return approximately split over the 3 different sectors, which would be S&P 500, hedging, and then risk-free assets. So you take 6%, which is what it would be, divided by 3 to get to 18, which is how much she needs. So she can allocate 68% of her capital, or like all of her cash, and then you multiply it by the desired return and the amount in which she needs to receive for her market. And so she would invest 41% in S&P 500 stocks, 27% in hedging, and then 31% in risk-free assets like 10-year treasuries.
And I did chapter 3, problem 11. This one basically asks about the margin calls. When do you get margin calls? So you bought 1,000 shares at $20, so that's $20,000 bucks. You borrowed $5,000 from the broker dealer. You invested 15, and you have about you have 15,000 in equity in the deal. So the question is, what's your rate of return if the stock price goes to 22 bucks? So it's 22 times the 1,000 minus the 5,000 that you borrowed gives you 17,000. And then your gain, your percentage gain, is the 2,000 that you gained divided by the initial 15 is going to give you 13.33%. If the stock price goes to 20, there's no gain, so no return. If the stock price goes to 18, you have negative 13.33%. If the price goes to $22, you have a 10% gain. So the question is, what's the gain by the investor? So it's the 10% times the 20,000 divided by the 15,000 gives you 13.33%. And then the question is, what is the margin call? What's the price in which you would get a margin call with a margin of 25%? So it's the 1,000 times P minus the 5,000 equals the 0.25 times 1,000 P. So then you just rearrange it. So what I did was I took 0.25 of the 1,000 P. I get 250 P, I bring it over to the other side. 1,000 P minus 250 P gives me 750 P. I got the 5,000, I take the 750 divided by the 5,000, and I get a $6.67 margin call. So if the price drops to $6.67, I get a margin call. Also, it said, well, what if I only invested 10,000 instead of 15,000? What would be the margin call? So because I'm putting in less money, the margin price goes up. So as the price goes down, it doesn't have to go down that much before I get a margin call. So the initial investment will have an effect on the margin call price. Okay. And I also borrowed some money, and then we also did different return calculations using the different prices. So if the price goes to 22, I get 10.67%. If it goes to 20, I get negative 2.67%. If it goes to 18, I lose 16% on my money. Also, the last one basically asks, what's the relationship between the percentage return and the percentage change in the price? For example, if the stock price goes from $40 to $44, that's a price change of 10%. So what I would do is I would take the 10%, I would take my total invested amount divided by my equity minus the 8% that they're charging me, on the margin loan that I'm getting. I borrowed $5,000 divided by the $15,000 equity. You take those two, subtract it, and I basically get a gain of 10.67%. And the last question is, the value of the 1,000 shares, blah, 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 you will receive a margin call because you took on some margin. Your margin price, again, is going to be higher so that the stock price drops. It doesn't have to drop that much to hit the margin because you borrowed the money. Okay, so the initial amount and the amount that you borrow will have an effect on the margin price in which the margin call will occur. Who's got chapter 3 engraved?
So this question deals with if you were to sell 100 shares, how much would you sell it at? Right here it shows the table, so the 100 shares you would be selling it at $50.25. And then the next question asks, what is the next price that you would sell it at 100 shares? And it would be $51.50. And then the third question asks, if you were a security dealer, would you want to increase or decrease your inventory of this stock? And since a lot of people are buying this type of stock, then you would want to increase it because it's low risk, and then a lot of people are buying it for a low price as well.
So chapter 3, number 13. And the question is, here's some price information on Marriott. You got your bid and your ask. You have placed a stop loss order to sell at $70. What are you telling your broker? Given market prices, will your order be executed? So the broker, you're instructing them to attempt to sell your stock as soon as the stock trades at a bid price of 70 or less. Obviously, 69.95 is lower than 70. So your broker's going to try to execute the trade, but since it's already below 70, it's not necessarily going to sell at 70 because it becomes a market order to sell at the current market price. So it's going to sell at 69.95 right now.
So chapter 4, number 19, we're trying to find the returns over 1, 3, and 10 years for 2 different funds, assuming a $1,000 investment in each fund and a yearly growth rate of 6%. The loaded up fund has a 12B commission fee of 1% and an expense ratio of 75 basis points. The economy fund has a front end load of 2%, so it would be 1 minus 2%, which would keep you to 98%, or 0.98, and an expense ratio of 25 basis points. And you can see that in 1 year, the loaded up fund would yield a higher return, but over time, the economy fund would yield a higher return.
So I had chapter 3, question 14. It gives you the bid price of $55.25 and the ask price of $55.50. So it says, at what price will your trade be executed? It's $55.50. Question B says, at what price will your trade be executed? That's $55.25. C says, suppose you have submitted a limit order to sell at $55.62. What will happen? The trade will not be executed because the bid price is lower than the price specified in the limit sell order. And part D says, suppose you have submitted a limit order to buy at $55.37. What will happen? Again, the trade will not be executed because the asked price is greater than the price specified in the limit buy order.
So I had chapter 7, question 8, and it's basically just asking you to find the reward to volatility ratio of the optimal cow. So you just use the formula given and the numbers given as well, just plug them in, and you end up getting 0.046 or 1.
Alright, mine says,
traders open an account to short sell 1,000 shares of Internet Dreams from the previous problem. The initial margin requirement is 50%, and a year later the price of Internet Dreams has risen from $40 to $50, and the stock has paid a dividend of $2 per share. So what is the remaining margin in the account? So the initial margin was $20,000, and you got that by multiplying 1,000 times 0.5 times 40. As a result of the increase in the stock price, Old Economy traders lost $10,000. Therefore, margin decreases by $10,000. Moreover, they must pay $2 dividend per share to the lender of the shares, so the account decreases by an additional $2,000, which was 2 times 1,000. The remaining margin is $8,000, so you just take the initial margin minus the $10,000 loss minus the dividend loss, you get $8,000. B asks, if the maintenance margin requirement is 30%, will Old Economy receive a margin call? So the percent margin is 16%, so there will be a margin call. And C, what is the rate of return on the investment? So you take the loss and then you divide it by the original margin, and you get negative 16%.
Thanks, Matt.
So chapter 3, question 10 talks about more margin stuff, and so question A is how much cash or securities must you put in your brokerage account as the broker's initial margin requirement is 50% of the value of the short position? And so to calculate the value of the short position, which is going to be 100 shares times $50 per share, which is $5,000, and then it's asking for 50% of that, so 2,500. And then for part B, it's asking how high can the price of the stock go before you get a margin call if the maintenance margin is 30% of the value of the short position. So basically, you're just trying to find a price that you plug into this equation that's going to get you 30%, and that is 57.69. And once the price hits that number, you issue a margin call.
Thank you.
So I have problems 15 and 16 in chapter 7, and 15 is just asking, has the probability and rate of return for 2 investments, and it's asking you if you're going to remove portfolio, what would your mean, and what would your mean return be, and what would your standard deviation of the portfolio be. So you just plug in the probability and multiply the probability by the rate of return for each. You add those two together, you get 55% for your estimated rate of return, the mean return for your portfolio. And then to calculate the standard deviation, you do the variance first. So you probabilities times 100, which is the rate of return, minus 55, which is your mean. Add those together, get 47.25 square root. That's your standard deviation, 68.74%. And then for 16, it's asking what your rate of return is for your portfolio. Again, you have a 12% return, I think, on a risk-free asset, and then 30% return on a risky asset. So you calculate the beta, throw that into the estimated return equation, run it, you get 25.5% your estimated rate of return for your portfolio.
I did chapter 7, number 12, and they give you this information for stock A and B, and they want you to make or find the risk-free rate when it's correlated with those two stocks. Since it has a negative correlation, you're able to do a risk-free portfolio, and when conducting a portfolio, you need to find the total aggregate weight for each of the stocks. Start out with stock 1, use this formula, plug it in, and for stock A, you get an aggregate weight of 66.7%, therefore the other percent is 33.43. And when you have those two percentages, you multiply those by the estimated return for each stock, A and B, and then add them together, and the sum gives you the risk-free rate of 11.67%.
I have chapter 7, number 10, not number 7. I wrote that.
you're supposed to find the proportions of the stock fund to the bond fund,
In the right place.
and,
Keep going.
so you plug in the values they're given into the formula, you solve, you get the stock fund at 25, so therefore the bond fund is going to be 75%. You plug in the 25 and 75 into the standard deviation formula, and your standard deviation is 14.13, which is greater than the T-bill, which was 13.04.
Excellent. And then we'll have chapters 7 and 8 on Friday, and then I'll continue to go through the optimization procedures, because it's part of chapter 8 anyway, okay? And then we have the finance club meeting. Don't forget to keep these problems, so you sign them and date them. So you can get homework credit for them. I'll work on the derivatives trading platform from CME. Anybody interested in a summer equity research associate position, equity research? Did everybody put in their stocks and start trading the equity sim? We can also do that on Monday as a part of the lab. And then I'll continue to look at your memos and your pre-tests and that stuff, and start thinking about I'll look at your passive portfolio worksheets, I'll look at your memos, and start thinking about putting together the presentation for the quiz.
The equity sim is an individual
It's individual, but you can still work together.
but can we do, so we can do different stocks and
Yeah, if you want to, yeah.
Yeah, but then she.
Okay, literally like two hours.
Same data.
Yes, sir.
Is the finance club meeting here?
Yeah, in here.
Got it.
Is this 2:30? 2:30?
I think so.
Yeah, 2:30. We're gonna be in here, and if somebody walks in there, yes. But I was just wondering. No, you don't. And then if you want to get together and go over some trade strategies and some language to put in there to make you sound really smart. Okay. I'm so sorry.